The biggest challenge they're having is finding the inventory and identifying a property. And when they do, this is the heartache, is a lot of times they're investing in new builds.
What would you say is the biggest frustration when it comes to the 1031 exchange for yourself, family, investors? What would you say that comes to mind there? Or any stories come to mind?
Oh yeah. Well, I got two stories or two examples, if that's okay. I just the first one's a quick one. Is a 1031 exchange is what got Kathy and me into real estate in the beginning back in 1997. We just got married. Kathy's dad was invested in a small apartment complex. His partner sold without telling him, and he got a letter from them, which they, snail mail. He got this, and he had a lot less time to identify and to acquire and close on a property with his 1031 exchange. So he was freaking out a little bit. He was going to have a huge tax bill. He called his 5 kids and said, "Hey, look, I need to find a property. I need to identify a property really fast here." And so Kathy just was like, went after it, and she searched all over, and she found this 4,100 square foot home in Lafayette, California. It was newly built, beautiful place. And we were able to, he did his 1031 into that. And basically we became his tenants. So he did a like-kind property, acquired that. And then we converted that, because the mortgage was way too huge for us at that time. We converted that home we house hacked back then, it was called house hacking, right? And we took the bottom level and we turned 2 units. We turned them into 2 units. We put a kitchen in and bathrooms, and then the master bedroom had its external staircase outside. So we blocked that off to the rest of the house. So we basically became landlords then, early in our marriage. And that property, that was in 1997. So, 1997, things started to appreciate, especially in California real estate. After that, that house went up about 100,000 a year. After that, we were able to do a cash out refi. Kathy's dad passed, which was sad, but at the same time, with that 1031, we didn't have the tax on it. So that's the happy story of the 1031 in the sense of how it helped us. What I see the most frustrating thing right now with 1031 is with the investors at Real Wealth, and we help them get into. They come to us and then like, we have a 1031. We just sold a high value property in California. We want to diversify. We want to move into the Southeast. We want to get multiple properties or an apartment or whatever. The biggest challenge they're having is finding the inventory and identifying a property. And when they do, this is the heartache, is a lot of times they're investing in new builds. And so they're not even built. And then all of a sudden, this happened over this past year with the supply chain issues. These new builds were supposed to be done in 6 to 8 months. All of a sudden, it's taking 12 to 18 months. And all of a sudden, it's going past for the close of, when they identified and all that. And that's created a lot of challenges. So supply chain issues and inventory seems to be the biggest challenge right now for 1031 investors.
Yeah, I appreciate you sharing both sides of that, right? Because 1031 exchanges are an amazing way, especially over the last 30 years, to create some real wealth in real estate and defer those taxes and build. But it wasn't great for 2008 when people had overpaid in 06 and 05 and 07, and then had too much debt, not enough liquidity. And all of a sudden, some clients, I had friends and friends lose half or everything within a 3-year period. It was terrible, because they had built wealth for 10, 15 years. One guy had $50 million. And so that's part of why we started our company, was to give people an alternative or even a backup plan for this scenario you're talking about, where they're running out of time, but they don't have a property lined up, or they can't close it in time. And so without using a Delaware statutory trust or a TIC, or having to go in with a bunch of partners, you can put it into this trust. It's called a Deferred Sales Trust, and it saves a failed 1031 exchange. And then you can have the time to buy a deal the next day, or actually go build brand new construction with the funds, all tax deferred. It can also go into alternatives. I call these alternatives stocks, bonds, mutual funds. It can go into insurance. It can go into cryptocurrency. It can go into business startups. So I'm curious, Rich, have you heard of this before? And if so, have you ever seen it done? I'm always curious on people who've been in the business so long, what their thoughts on something like that is.
I haven't seen it done. I have heard of it recently because it's also a DST, right? And whenever I hear DST, I think Delaware Statutory Trust. But Deferred Sales Trust, is that it?
Yes, correct. Yeah. Exactly. Yeah.
So, honestly, I think I heard that about that maybe a month ago and maybe 2 months ago. Yeah. So it's just like, I'm like, oh yeah, someone was saying it and DST. And I was, in my head, Delaware. And then I was like, so wait a minute, you're talking about something different. And then I just learned of it recently. Sounds amazing.
Yeah, we just did a deal out of San Diego, $12.75 million sale, and they actually buy the land and they build a car wash, and they all in for about $4 million. It's 4 partners, and they sold it for about $13 million. And they don't do 1031 exchanges because they're not buying $13 million car washes. They're buying land for $500,000 or so. They're building for about $3.5 million, and they rinse, wash, repeat. And so they've been doing this and paying all this tax. Now they find us and they defer millions of tax. Each partner can have their own separate trust, and they can still use the funds to go do what they would have done. And so in California alone, you're looking at 37 minimum for investment property. Obamacare 3.8, federal 20, state 13.3, plus depreciation recapture, so it's usually about 40%. And so this is the part where I say it's just not about cash flow, Rich. It's about tax flow, because if you're not before they come to you with the money, right, or you're on the exit of the money, if you're not accounting for that, it can be lower in other states, 25 to 50% with depreciation recapture. That's a huge return, right? That's a lack of return. It's almost like if you couldn't account for depreciation on these investments. And so most people, they're just focused on what's my return on my investment and then what's my tax flow within the investment. But what about the outsides, on both sides? And so this is the part where I'm like, it's why we're here, and we're coming out the book with, by the way, I'm going to plug this. We got a book coming out with Kevin Harrington from Shark Tank. He'll be in the book, which is pretty cool. It's called Building a Tax Deferred Exit Strategy. Nice. And for anyone who wants to learn about this, you can go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com.